If I asked you how much risk you're willing to take with your money, you'd probably give me a number. But the truth is, most of us don't actually know our relationship with risk until the market starts dropping and that number starts feeling very, very real. Investing is a constant tightrope walk. On one side, you have the desire to grow your wealth. You can live the life you want. On the other, you have the instinct to protect everything you've worked so hard for. It's a battle between your math and your psychology. Today, we're going to stop guessing. I'm going to walk you through a framework used by the pros, the DFA Institute, to help you find your unique risk profile. We're going to look at the building blocks of a portfolio, but more importantly, we're going to look at you, the driver of the car. Let's head to the video session and find your perfect balance.
All right, let's talk about one of the trickiest parts of investing, your own personal relationship with risk. Figuring out your unique risk profile is really the first, most important step to building a financial future that you can actually feel good about. So, the CFA Institute really frames the central dilemma that every single investor faces. It's this constant tightrope walk, right, between trying to grow your money and trying to protect what you already have. Our goal here today is to give you a solid framework to find your answer to that question. But before we can get all personal and figure out the you part, we really have to understand the tools we're working with. So first up, let's do a quick flyby of the basic building blocks that make up pretty much any investment portfolio. First up, we've got cash and its equivalents. Now, you should think of this as the foundation of your portfolio. It's the safe harbor, it's liquid, it's accessible, and its main job isn't really about growth. It's about providing stability and safety for when the markets get a little choppy. And of course, here's the trade-off. With cash, your risk is super low. But the flip side of that coin, a very, very low potential return. It's safe, for sure, but over the long haul, inflation can actually eat away at its buying power. Next up on the list, fixed income. Most of us just call them bonds. When you buy a bond, you're basically acting like a bank. You're lending money to a government or a big company. And in return for that loan, they promise to pay you back with regular, fixed interest payments. It's all about generating a predictable stream of income. So bonds are the next step up the risk ladder. The return is predictable, which is great, but the risk moves up to moderate. And this risk usually comes from two main places. One, the chance the company or government could default on the loan, and two, the risk that changing interest rates in the wider economy could actually make your specific bond less valuable. Okay, now for the stuff you can actually touch, real assets. We're talking about things like real estate or commodities like oil and gold. These things have real physical value, and they can be a fantastic way to diversify a portfolio. Real assets can pay off in two ways: through appreciation, that is, their value going up, and through income, like getting rent from a property you own. The catch is that their value is often tied pretty closely to the broader economy, which puts them firmly in that moderate to high-risk category. And finally, the big one, equities, or as we all know them, stocks. When you buy a stock, you're not just buying some letters on a screen. You're buying a tiny slice of ownership in a real company, and that gives you a claim on its future success. And right here is the classic investing trade-off, isn't it? Stocks offer the highest potential for returns, no question. But they also come with the highest level of risk. It is the absolute definition of high risk, high potential reward. That's the game when you're dealing with equities. Okay, we've thrown that word risk around a lot. But what does it actually look like? How does it work in the real world? Let's use bond interest rates as a quick, tangible example to make this whole thing a little more concrete. Just think of it like a seesaw. When new interest rates out in the market go up, the price of your existing bond with its lower rate has to go down. I mean, it makes sense, right? Why would anyone pay full price for your old 4% bond when they can just go out and buy a brand new one that pays 5%? This inverse relationship is a fundamental risk every bond investor has to understand. So, we've covered the building blocks and we've seen a risk in action. Now it's time for the most important part of this whole equation, you. How do we take all of this market theory and build a strategy that actually fits you personally? This quote from the CFA Institute just hits the nail on the head. It's not just about your financial numbers, it's about your emotional aptitude. A great investment plan has to work on paper, yes, but it also has to let you sleep at night. It's this delicate balance of math and psychology. So how do we find that perfect balance? Well, the CFA Institute gives us a great three-part framework. We need to look at our risk need, our risk-taking ability, and our behavioral loss tolerance. which is really just a fancy way of saying how well can you stomach the swings. Let's break each of these down. First up, risk need. Let's think of it like you're on a road trip. Your financial goal is the destination, and based on when you need to get there, there's a certain speed you need to be traveling. In investing, this is simply the rate of return you require to hit your goals. It's just a math problem. Next, let's talk about risk-taking ability. This is about the car itself and the road conditions. How much gas you have in the tank, how's the engine running. Financially speaking, this is your objective capacity to take risks. How long until you need the money? Is your income stable? This is your reality check. And finally, we get to behavioral loss tolerance. Now, this one is all about you, the driver. Are you a thrill seeker who loves the speed, or are you white-knuckling the steering wheel going 5 over the limit? This is your emotional stomach for risk. Can you handle those gut-wrenching market drops without panicking and selling at the worst possible time? So, we have our 3 components, right? The speed we need to go, the speed our car can physically go, and the speed we're actually willing to go. The real magic, the key to a good strategy, happens when we bring them all together. And this really is the million-dollar question. Because let's be honest, these 3 things almost never line up perfectly. What happens if you need to drive fast to reach your goal, but you're a really nervous driver? Or what if you love going fast, but your car is, well, old and unreliable? Okay, this is really important. Here's the logic for figuring out those conflicts. And I want you to pay close attention to this part. Your risk-taking ability, your financial reality is a hard ceiling. It's non-negotiable. Look at that first row. If you need a high return, but your financial ability to take risk is low, you can't just floor it and hope for the best. The only responsible move is to reevaluate your goal. Maybe that means saving more or pushing out your timeline. Your financial ability always wins. It dictates the final strategy. So let's bring this all home with 3 key takeaways. First, diversify your portfolio. Use a mix of those asset classes we talked about at the beginning. Second, you have to do the personal work. Really assess your own unique need, your ability, and your tolerance. And third, make absolutely sure your final strategy respects the limits of all 3, especially the hard limits of your financial ability to take on risk. And that leaves us with one last question for you to think about. I want you to take a hard, honest look at your own investments. Is your portfolio actually built for your goals and your financial reality? Or is it just built for your feelings? The answer to that question is the key to a successful investment journey. Thanks for listening.
It's a powerful realization when you finally understand that your financial reality is the hard ceiling. You can be the most fearless driver in the world, but if the car is out of gas or the engine is old, you simply cannot drive at 100 miles per hour. The goal of this isn't to make you brave or conservative. The goal is to make you aligned. When your risk need, your ability, and your emotional stomach are all speaking the same language, that's when the stress disappears. That's when you can finally stop checking the markets every 5 minutes and start enjoying your life. So I'll leave you with that final question we asked on the video. Is your portfolio built for your goals and your reality? Or is it just built for your feelings? If you want an objective look at your car and your speed, let's run these tests together. Subscribe to keep building your financial self-awareness with me, and reach out through the link below to start your personal risk assessment.